In this class, I am going to calculate the expected return based on the probability model. Based on the probability model. Let's try to solve this one now. If the probability is given, how can we calculate the expected one? The expected one is very simple. Multiply the different returns expected along with the probability. This is return, this is probability. If I multiply the probability and return, and then take the summation, this is nothing but mean return. Mean return, expected return, otherwise named as mean return. Usually this is x, this is x into probability and summation of x. Like. Yes, come on, get me the value here. Two methods we have. So earlier we have one method based on the past year's profit. We calculate the average. Here we predict the future and we calculate the expected one. So predict the future means the coming days we may expect the rate of return may be either 5%, 10%, 8%, or 11%, and associated property also be given. So if you multiply these two and take the average of this, means summation of this is called expected return. So the expected return in this case being 0.01, 0.04, and 0.008 and 0.033, overall value being 0.091, otherwise 9.1 percentage. 9.1 percentage. Okay. 1 percentage, 4 percentage. This is 0.8 percentage, I think. Am I right? Okay. Finally, 3.33 percentage. You can do this way also. In percentage, 1 percentage, 4 percentage, 0.8 percentage, 3.33 percentage, 9.1 percentage. Is that okay? Rather, you can show that in decimal or you can show this in percentage also. Okay. And so under this model, average being simply multiplying the various returns expected into applicable probability for that. Applicable probability for that. How to calculate standard deviation here? We assume this one being x bar. You have to find out x minus x bar and to the power 2. Multiply with the probability. If you sum this is nothing but variance or standard deviation square. Standard deviation square. Then you can find out the standard deviation easily. The x is nothing but the return what you earn as per your estimation minus x bar is nothing but expected return 9.1. 5 minus 9.1 being how much? 5 minus 9.1 to the power 2 multiply with the probability 0.2. This is the way you have to calculate for this value. Come on, get me the value. I think this value being 3.362. Okay. Similarly, next one, probability being 0.4 and 10 percentage minus 9.1 to the power 2. This value being 0.324. Next, 0.1 into 8 percentage minus 9.1 to the power 2. Hope this value being 0.121. Finally, 0.3 into 11 percentage minus 9.1 to the power 2. Hope the value being 1.083. Variance being this one 4.889 and standard deviation being 2.211. This is standard deviation. Hope now we'll be able to understand this. Clear? This is for future calculation. Earlier one is the based on the previous year's estimation. It's a probability based, there is estimation base. Means actual base. Actual of the previous years will be taken as a base. Right. Now, this one, consider the two securities A and B whose normal probability distribution of 1 year returns have the following characteristics. X is nothing but expected return and standard deviation is the deviation from this. So this communicates risk of the investment. Coefficient variation is nothing but expressing the standard deviation in relative term is nothing but risk by return. 0.06 divided by 0.08 is the covariance. Comment on the information. Comment on the information. Based on the return, B is superior. It gives you more return. What is chosen? The investment gives you more return will be chosen. So here B is superior than A. So we have to choose B. Standard deviation, it's talking about risk. You need to be careful with respect to the risk. So B is higher risk. A has lesser risk. You have to choose A. And coefficient variation is also relative term. Also, it's the indication to study risk only, but relative term. Okay. So while going for the relative term, B is superior and B is riskless. Okay. As per the standard deviation, A is riskier. As per the covariance, coefficient of variations, B is risk-free or A is riskier. Okay, sorry. As per the standard deviation, B is riskier. As per the coefficient of variation, A is riskier. Scoring 60 marks and 70 marks, which is better? You say 70 is better, but this is out of 100, this is out of 200. Then this is 60%, this is 35%. Now this is superior. If you say this way, this is standard deviation. If you say this one, this is called coefficient of variations. So for the 100 rupees, how much you scored? Or for the 100 marks, how much you scored? For mean 0.08, what is the deviation? 0.06. Almost 75% deviating from the base. But in this case, 0.08 deviation is higher for the base of 0.24. So naturally, this will be lesser comparative relative term, but absolute term, standard deviation is higher. That's how you can interpret the meaning here. Clear? So our intention is to think over to reduce the risk and increase the profit. Okay, if you want to reduce the risk and improve the profit, is there any possibilities? If you ask that question, of course we have. Here, two famous authors recommended two methods of finding in what combinations if you are adding two investments. So that if you are constructing that as a portfolio. Investment is nothing but investing in one share. Portfolio is nothing but investing in 2 or 3 different shares. Then it is called portfolio. Investing completely in one share, you cannot reduce the risk. So if you start and run tea shop, during the winter season, your profit gets affected. But if you start tea shop and along with the cool drinks, okay, during the summer, you get more revenue from the cool drinks and during the winter, you get the revenue from tea shops. So if you are having these two blend in your office, you will have the constant return. Starting and running tea shop is investment. Starting and running in tea shop along with the cool drink shop is called the portfolio. Now, what happens if I start and run tea and coffee shop. If I run tea and coffee, then naturally what happens during the summer, definitely my revenue will be lesser. But if I start with the tea and ice cream, I will have the constant revenue throughout the year. So, what two different investments are going to be clubbed so that your revenue will be constant is to be decided here. It's not tea and coffee, it's all about tea and cold drinks, maybe a matter. For this, the idea is given by two economists. One is Markowitz, another one is William Sharp. But anyhow, you'll study all those things in detail along with your final study. But I don't know why they have included in your CMA interlevel. This particular content is for final. But only one question as a discussion is available in your CMA material. So I have incorporated for ideal purpose only. Most probably you may not expect this question in your examination. Anyhow, I just go with the detailed calculations. Some two or three additional questions I usually solve for the CMA final level, not here. Here you just understand the logics. Two ideas are there, right? So one is all about idea propounded by Markowitz, Harry Markowitz. So you have to understand these formulae here. Another is William Sharp. William Sharp. So you have to understand that logic also. Okay. Two logics. So this is William Sharp model. Okay, we are going to study these two. I try to finish up all these things in this class. Requires more calculations in order to avoid that. As it is inter, you no need to worry about the calculations part. I may just directly show you how the calculation is arrived and then I'll interpret the results here. Now, let's start with question number 1, practical problem. Practical problem, question number 1. The stock of A Limited performs well relative to other stock during recessionary period. Clear? Just like I told you, no, tea performs better during winter, ice cream performs better during summer. So it's better to have both the shops with you so that you will have consistent return over the year. Stock B Limited, on the other hand, does well during the growth period. Both the stocks are currently selling for rupees 100 per share. You assess the rupee return. Rupee return is nothing but if you invest 100 rupees, you will be getting 105 rupees or 110 rupees, like, okay, that is called rupee return. Clear? So we have already studied what? Total return and return relative. This return relative is otherwise named as rupee return. Okay. In this illustration, if you purchase a share for 100 rupees, in case of stocks of A, in high growth you will get 100 rupees. There will not be any change in your investment. If the business is or the economy shows a recessionary period, your 100 rupees will grow 140. As already know that A Limited performs better in recessionary period. If you invest in A and find that the current economy being recessionary nature, you will get 140. In case B, if you invest 100, if the economic condition is showing high growth, your 100 rupee becomes 150. And during the recessionary period, you will get only 60. What you can do? You can either invest the entire 1000 rupees what you have for investment purpose. Okay. Assume 1000 rupees you have to be invested only in A Limited. What could be your situation? If you invest the entire 1000 rupees for B Limited, what could be your return? Or rather than doing this way, 500 rupees in A as well as another 500 rupees in B. Investing in two or three different shares out of the amount available, then it is called portfolio construction. Putting all the money in one basket is called investment. So first two are investment, the third one is portfolio construction. Now the question is the portfolio is superior than the investing in either A or B? That's what about the question. So as per the mark bits, I am going to teach you how this portfolio plays a vital role in reducing the risk as well as increasing the return both. Anyhow, we have to calculate what we have to calculate? We have to calculate expected return, otherwise named as X bar. How do you calculate? How do you calculate this one? Return multiplied with the applicable probability and take the summation of this. This is what about expected return of the X. Not only that, to find out the risk, my intention is not to make huge profit. My intention is to make good profit along with the reduced risk. So not only calculating the expected return, I have to calculate the return associated with, the risk associated with that also. How do you calculate the return risk here? Risk is nothing but X minus X bar to the power 2 multiplied with the probability, and summation of this is variance. Finally, you have to take the root of this. That's how we calculated in the previous illustrations. We have to calculate the expected return and standard deviation for A as well as B. A as well as B. As I already told you, it takes lots of time, so I may just show you the calculations part directly. Calculations part directly. Yes. In case of this one, this one is for only understanding purpose. I'll do this way. Yeah. So high growth, low growth. You have to multiply these two. And then take the summation of this. This is called what? Expected return of A. Expected return of A. See here, I have posted all the probability. If you invest 1,000 rupees, how much you will get? 100 becomes 100 means 1,000 becomes 1,000. Here 1,000 becomes 1,100. 1,000 becomes 100 becomes 120 means 1,000 becomes 1,200. 100 becomes 140 means you are investing 10 shares. Okay. Then your amount being 1,400. How can you calculate the expected return? Multiply the probability and the applicable return for investing in A. 1,000 into 0.3, 300. 1,100 into 0.4, 440. 0.2 into 1,200, 240. 0.1 into 1,400, 140. This is called mean return. Mean return. So for the mean return, the formula you know that, right? X bar, the mean return or expected return is equal to, you have to multiply the various return with the probability and take the summation of this. So we got this value. Not only that, we have to calculate the standard deviation. To calculate the standard deviation, what do you have to do? X minus X bar to the power 2, multiply with the probability, take the summation, then it is called variance, and take the root of this is called standard deviation. So here instead of X, I use A and A bar here. To differentiate that X and X bar for A and B separately, I use the term A and A bar. A minus A bar to the power 2 into probability and take the summation. This is called variance, and taking the root will be standard deviation. Is that clear? Hope you will be able to understand how to get this value. Try to calculate one number and verify that the same is repeated for the rest. For the first one, 1,000 minus 1,120 to the power 2 into probability 0.3 will be 4,320. Cross verify. Will you be able to get this answer, and are you able to understand this? Once it is clear, I will move on to the next one the same way. Online students, text me, are you able to get 4,320 or not? Okay. So I get Magisha answer from Magisha. What about the others? Keep texting me. The same way you can calculate for all the other four scenarios. Take the summation of that and take the root of that. That's the standard deviation. So Hamim Faisal also got the answer. In case of investing in B, 10 shares you are purchasing. Per share rupees 100. For 1000 rupees you are purchasing 10 shares. Every share becomes 150 in case of high growth. For 10 shares, 10 into 150, 1500, 10 into 130, 1300, 90 into 10, 900, 60 into 10, 600. And to find out the expected return for the investments in B, you have to again multiply the probability with the return of B and take the summation of this. So 1210 will be the return, mean return for the investments in B. Similarly, you have to calculate the standard deviation for the B also by applying the same formula, x minus x bar. Here in this case being x being this one, 1000, x bar, sorry, 1500, x bar being 1210. So this value can be calculated this way, 1500 minus 1250, so 210 to the power 2 multiplied with the probability for the first scenario being 0.3. Hope you will be getting to 25,230 here. Repeat the same for the rest of the 4 and add this. This is called variance and take the root of this. So you'll get the standard deviation here. So out of available 100,000 rupees, if you invest completely in A by purchasing 10 shares in A, your mean return being 1120 with a standard deviation rupees 117. Rather than that, the same 1000 rupees is invested in B, purchasing 10 share, you will get 1210 being the return with a standard deviation 291. From this, it is very clear what's that. If you are investing purely in A, your return is only 1120, but risk is also lesser. Instead of that, if you are investing in B, your return is 1210. Rather than 1120, you are getting 1210, means almost 90 rupees you are getting excess. Though you are pretty happy that you are getting 90 rupees excess, but your standard deviation is not 117, 291. From the mean, in negative sense, minus 291 may happen, or your money may also go off. 1210 minus 291. What is the approximate value? 919. You invested 1000 rupees, ended with 919 in case of worst scenario. But here, in negative scenario, only 117 is subtracted, still 1300. You will be safer with your investment if you are investing in A. If you are investing in B, in best scenario, you will be getting high income. In worst scenario, you will get lesser income. Okay, best income, but due to the heavy standard deviation, you get negative values. Hope you will be now able to understand. Now here, we have calculated the mean return as well as standard deviation for investments in A as well as B. Rather than investing completely in A and completely in B, so we now plan to segregate our amount available to be invested in C as well as A and B. So here 500 equity shares, 500 rupees is invested in stock of A Limited and another 500 rupees for B. So currently the value is 100, means 500 rupees divided by 500. So 5 shares in A as well as 5 shares in B. What happens in this case? See, your return in this scenario being means portfolio. I can name this being portfolio. It's a combination P, portfolio. You will get 5 shares invested here and 5 shares invested here, means your investment becomes 500 rupees. The 500 rupees becomes 500 rupees by the end of the first year for stock A if the economy is high growth. Another 500 rupees if you invested in B, no. That 100 becomes 150. You have invested 5 shares, means 150 into 5. 750, you now add up these two, you will be getting 1250. Similarly, next year, as in the case of low growth, 110 into 5, 130 into 5 will be your amount for the low growth scenario. Stagnation scenario, 120 into 5, 90 into 5 will be your return by the end of first year. And in case of recession, 140 into 5 and 60 into 5 will be your return. Hope you will be now able to understand. This will be assumed in the X, or returns expected under different scenarios. Now you have to find out the expected return for the portfolio. How do you calculate the expected return? So you have to multiply the probability and this return, probability and return. 0.3 into 1250, 375, 0.4 into 1200, 480, 0.2 into 1050, 210, 0.1 into 1100 rupees. So here your expected return being 1165. Is that clear? Now again you have to calculate what? You have to calculate standard deviation. Standard deviation being x minus x bar to the power 2 multiplied with the probability and take the summation. This is the variance, and to calculate the standard deviation you have to take the root of this. Here x is nothing but the amount what you get here, 1250. X bar is the mean what you have calculated, 1165 to the power 2, and applicable probability in this case being 0.3. Hope this value will be equal to 2168. You will be able to get this value, cross verify and let me know. Check and tell me, online students, are you able to get this one? Similarly, you are getting this value for all these options, and average of this variance being this one. And if you take the standard deviation, you will be getting 90. Cross verify and confirm, will you be able to get this answer? Now I am going to teach you the interpretation. What happens if you are investing 1000 rupees fully in A? Your 1000 rupees becomes 1120 subject to a deviation of 117. Rather than investing in A, if you are investing in B, 1210 you will be getting subject to a standard deviation of 291. So for A, for B, return 1120, in case of B 1210. And what about the risks, sir? A gives you lesser return, but risk is also lesser, 117. But in case of B, risk is higher. So if you are going to be the risk taker, then you can invest in B and take the challenge to get higher revenue. Never bother about the losing your money. But if you don't want to lose your money and you need to moderately gain, if your attitude being the risk averse, then you can invest in A. That's how we can give the suggestion. Rather than investing purely in A and purely in B, so we can recommend, you can take the combination of this, so you can now enjoy some other benefits. How? In case of portfolio, your return is 1165. But your risk is 90. See, in this portfolio, your risk is the lowest one, but the return is higher than A, but lower than B. It means you face risk less than A, which is really advisable to invest, and return is higher than A. Definitely, the portfolio is superior. If you draw this in the diagram, see risk and return diagram, x-axis and y-axis, risk and return. Okay, probably I use the return here, risk here. X-axis is all about risk, y-axis is all about return. I'll start with the false baseline, 1000, 1100, 1200. In case of risk, I'll start with 100, 200, 300. I plot here. In case of A, my return is 120 and my risk is 117, somewhere here. 1120 and 170. This is A. This is A. Am I right? If you invest in B, my return is 1210, but risk is 291. If I invest here, this is B. More than 1200 and risk is also more than 290. This is the scenario of B. So what happens here? A, return is also lesser, risk is also lesser. If you are moving your dot towards y axis, then it is less riskier. And if the dot moves towards y axis, then your return is also lesser. So from this, it is very clear A is giving you lesser risk, lesser return. B gives you more risk, more return. But if you go for portfolio, your return is 1165 and risk is 90. See, as the B, the portfolio moves closer to y-axis, stating that risk is lesser, moves away from x-axis compared to A, showing that it is more returnable. Okay. If you connect all this dot, okay, the dot moves to the y-axis closer will be less riskier. The dot moves away from the x-axis will be the more returnable one. Don't blindly invest in A, which is giving you less return and bit more riskier than portfolio. In case of portfolio, its return is more than A's return, but risk is less than A. Then you have to go for portfolio only. So portfolio is the matter. Would you like to study one paper to score 100%? Or would you like to study 50 marks for all the papers? It is better. That's easier logically. Some of my students are always coming to me, sir, this time I try to study only one paper and try to get exemption. I tell him, no, it's not advisable. Because scoring 60 plus is equivalent to scoring 250 marks like in two papers. Okay, scoring 50 marks, just 50 marks in one paper is very easy. The efforts you put for scoring 50 for two papers is equal to the efforts you put for scoring 60 marks in one paper. The additional 10 marks, if you want to get, will be equal to scoring 50 marks in another paper. The same happens here. Always go for the portfolio. Don't invest in one share. Don't invest in one share. Now, in Markowitz model, the same logic is explained in different way. If I ask you, what could be the question comes in your mind? Investing in A is less returnable and more risk compared to the portfolio. Investing in B, more risk, more return. Risk, the portfolio is pretty okay. Portfolio means investing in A as well as investing in B. Now the question is, how much you have to invest in A, how much you have to invest in B? Is it 50-50? Why not 60-40? Why not 70-30? You understand? If I ask you to find out the exact one, you have to go for trial and error method. That's all. Even already the calculation seems to be pretty complicated. If you go for calculating all these things, definitely you fed up. Markowitz actually found out this logic, the logic I am supposed to teach you in 1970s, like 65 and 70s. Okay, he gives a pretty massive formula for the calculation purpose. Of course, for the stock brokers who want to invest in different shares to construct the portfolio, where they don't have the computers and other thing, they have to calculate all these things manually. What happens then? The price changes for every second. So fed up with applying the formula, then it was outdated by the time. Sometimes later, after the invention and addicted to computer, all this calculation is now handed over to the computers can calculate just like that. They fed the data and they derive the formula, use the formula to derive the answers, and it seems to be pretty simple. Then automatically this concept designed by Markowitz got picked up. Then immediately that Markowitz model came to your syllabus and he was awarded with Nobel Prize. For you, you have to at least pass with this same logic. See, this is a pretty massive formula. Right. William Sharp also got the Nobel Prize and he too got the Nobel Prize. This is what about the massive formula you have. This formula number 2 is for two share portfolio model. I need to add A and B in my portfolio. Then I can use this formula. If I want to add A, B, C, three shares in my portfolio, the same second formula is extended. If I want to add 15 or 20 shares in my portfolio, the formula runs through a page. So, anyhow, you just try to understand the logics. In this case, okay, in this case, let's see. How do you calculate the expected return for portfolio? Expected return for the portfolio can be calculated this way. Expected return of the portfolio or return of the portfolio in simple is equal to weight of security A and return of security A plus weight of security B and return of security B. That's how you can get the answer. What is the weightage you invest in A? 50%. What is the weightage of your investment is in B? 50%. 0.5. What is the return from A? 1120. What is the return from B? 1210. So 0.5 into 1210. What is the value you are getting? So if you ask you 60/40, simply you change the proportion here, weight of A being 60 and weight of B being 40. If you ask you 70/30, you can change and get the answer directly rather than working this much complicated way. And okay, what about the standard deviation of portfolio, sir? Standard deviation of portfolio. Can I use the same way? Weight of A, standard deviation of A, weight of B, standard deviation of B. We apply the same logic for return calculation. Can we use the same way for the risk calculation? 0.5 of A and risk of A being 117. 0.5 of B and risk of B being 291. What is the value you are getting? 204. Is it equal to portfolio's risk being 90? No. It is not matching. That's the trouble. So return of the portfolio, you can very easily calculate weight of A multiplied with the rate of A, return of A. Similarly, if you have 10 shares in your portfolio, you can do the same calculation easily. The same formula cannot be applied for the return of the portfolio, risk of the portfolio. That's the logic. Then Markowitz suggested a difference in formula that is going to be guided you here. So let's see. As per the Markowitz, the formula will be standard deviation of portfolio is equal to weight of A square and the standard deviation of A square plus weight of B square, standard deviation of B square plus 2 into weight of A into weight of B, standard deviation of A and standard deviation of B into correlation coefficient between A and B. This is called correlation coefficient rho. Rho, okay. Seems to be P like it's not exact P, okay. It's not exact P. Correlation coefficient between A and B. So he introduced this one. This is called variance. Then what do you have to do? Take the root of this. Take the root of this. Then it is called standard deviation of portfolio. This one item was introduced by Markowitz model to eliminate this calculation. Now he makes it simple to get the answer easily. Now, how to get the correlation of A and B, sir? To calculate the correlation between A and B, this one, correlation between A and B. Clear? Otherwise, rho. Rho of A and B is equal to covariance of A and B divided by standard deviation of A and standard deviation of B. This is the formula for correlation coefficient. Now, how do I calculate the covariances? Are covariance of AB. What is the variance of A? What is the variance of B? How do you get the variance of A and B separately? Variance is nothing but x minus x bar to the power 2. Is that okay? How do we get this one? X minus x bar to the power 2 is the variance. Now, this is nothing but variance of A. Variance of A. Covariance means variance of A with respect to the variance of the other one, A and B. It means x minus x bar of A multiplied by x minus x bar of B. This is related to A, this is related to B. If you take one from A, one from B, if you multiply, then it's called covariance. Then the formula being A minus A bar is the variance of investment in A, and B minus B bar is the variance of B. If you multiply these two rather than multiplying with the same, so in case of variance of A, x minus x bar into x minus x bar. Okay, in case of covariance, x minus x bar related to A, x minus x bar related to B. You have to multiply these two, then you will get the covariance. Is that okay? And finally, multiply with the probability and take the summation, you will get the covariance. Is that okay? I am going to calculate the covariance for the first number. Here. This is mean, this is what about the x. 1000 minus 1120 into, similarly here, 1500 and 1210. 1500 minus 1210, multiply with this and apply the probability 0.3. Come on, find out the final value. Minus 10,440, we got this. Same way we can calculate for the low growth, stagnation and recession and all. Overall value what you get here is called covariance. So here the covariance being minus 33,200. That should be divided by the standard deviation. Standard deviation for A being 117. Standard deviation for B being 291. Now, what is the final value you are getting? Minus 0.975 you will be getting. This is called correlation. This is called correlation. Clear? See, in case of Markowitz model, you have to understand what? These four formulae before you proceed further. Return of the portfolio is nothing but weight of A and return of A are first investment. Return of 2 and weight of 2 second, goes so on. If you have 10 different investments in your portfolio, weight of the 10th one and return of the 10th one will be taken. This is what about return of the portfolio. Standard deviation of the portfolio is this one. You already studied. And for the standard deviation, you need to have correlation. For the correlation, the formula being covariance between number 1 and number 2 are A and B investments divided by standard deviation of 1 and 2. To calculate the covariance, the formula being x minus x bar for the first and x minus x bar for the second investment, multiply with the probability and take the summation. So, these are the four formula you have to understand and memorize for the Harry Markowitz model. I explained this one and I just to show or written this one. I solved this one and this one. Usually remember correlation, no. This correlation final answer should be anywhere between minus 1 to 1. If the answer is not within this range, then you have made some error. You have to be double cautious. The correlation should be anywhere between minus 1 to 1. In this illustration, we got the answer being 0.975. minus 0.975, which is closer to minus 1. So minus 1 to minus plus 1. So we got the answer. Now I'm going to apply this in this formula. Okay. Weight of A being 0.5 to the power 2, standard deviation of A being 117 square, plus weight of B being 0.5 into standard deviation of B being 291 to the power 2, plus 2 into weight of A 0.5, weight of B 0.5 into standard deviation of A 117, and standard deviation of B being 291. Don't forget to multiply with the correlation coefficient between A and B you have calculated, which is minus 0.975. This will be the variance, standard deviation of the portfolio square. Okay. And if you take the root, then you will be getting the standard deviation here. If you calculate, the final value in this case is equal to 89. Already told the formula seems to be pretty massive and it consumes your time while solving. But I think at the inter level you may not expect the illustrations, but at least you need to know the logics. Surprisingly, if they ask, then you need to spend the time to get the answer also. Now the value what you get here is 89, which is equal to 90, closer number. We got the number. Only due to the rounding of error we get this number. Hope now you'll be able to understand the formula. Okay, what's the formula? In case of return of the portfolio, weight of A and return of A, weight of B, return of B, and goes so on. In case of two investments, this is the formula. Next being standard deviation of portfolio in case of two shares in the portfolio. Weight of A square, standard deviation A square, weight of B square, standard deviation B square, plus 2WA, weight of A, weight of B, and standard deviation A and standard deviation B, and correlation between A and B, and take the root of this. This formula is not tough to understand. It's very easy. Can you remember this formula from the school day study? Huh? A plus B whole square. A square plus B square plus 2AB. This WA, standard deviation A, is considered as A. WB, standard deviation B, is considered as B. Now you can easily remember this square, plus 2 into this one, and this one. Okay. WA square, standard deviation A square, plus WB square, standard deviation B square. This is A square and B square, plus 2A. A is this one, right? So 2 into WA, standard deviation A, and B is WB and standard deviation B. But finally, this one new item is incorporated by whom? Markowitz. Now you no need to worry about the mugging of the formula. You can very easily guess the formula also. Is that clear? Hope you will be now able to understand to arrive the formula easily. The main logic here is this component. This component is very interesting. This propounded by Markowitz. Okay. And to calculate this one, correlation coefficient between A and B, the formula being covariance of A and B divided by standard deviation of A and standard deviation of B. That's how we get the answer. Clear? And for the covariance of AB, okay, you have to take what? R minus R bar, return of A. I can use this being A minus A bar, like, into B minus B bar, and multiply with the probability. Multiply with the property and take the summation of this. That's how we'll get the covariance of A and B also. Clear? Hope now you'll be able to understand the formula here. Come on, make a note of it. And if you are able to understand the logic, text me So that very interesting concept is going to be discussed now. Of course, not for your examination purpose, but for understanding purpose. Make it faster. Make it faster. So, in case of question number 2, returns of two assets under four possible states of nature are given below. Four possible natures along with the probability. If you are investing in asset A, this will be your return. If you are investing in B, this will be your return. Calculate the expected return and standard deviation of investing only in A and only in B. That you can get it easily. Okay. Which is nothing but multiply these two and take the summation. This is called mean return, and you can get the standard deviation also. The calculation part and other things we have already studied in the earlier illustration. The same is given here. Investing only in A and B. This is what about the expected return only investing in A. This is the standard deviation. In case if you are investing in B, this will be your return. This will be the standard deviation. Okay. What is the covariance between the returns of asset A and B? Covariance, how can you calculate? Return of A minus return of A bar means mean. Return of B minus return of B bar and multiply with the probability and take the summation. This is what about the covariance given here. This is the covariance. And find out the coefficient of correlation between these two returns A and B. Coefficient of correlation, how do you calculate? Correlation is equal to rho is equal to covariance between A and B divided by standard deviation A and standard deviation B. Also calculated here. See. So we have been given return of the portfolio if the investment being 50-50%, standard deviation of portfolio this much, and for this we are in need of calculating correlation between 1 and 2. Correlation between 1 and 2 is calculated by this formula. Covariance we need, and covariance we arrived here and apply this, we will get all the answers. But one difference you have to note, the correlation should be anywhere between -1 to +1. Here, standard deviation of this portfolio being 0.56. What about the standard deviation of A? 0.04, and standard deviation of portfolio B is 0.07. Standard deviation of the portfolio is actually higher than A but lower than B. But earlier case, it is lowest one compared to A and B. Okay, why? That why is very, very important. That's why Markowitz model becomes very popular. In what are the nature stocks can be formed as a portfolio in your case? So I already told you, no, tea and coffee shop is not better than tea and cool drink shop. Right, the same logic. Both are inversely related. If both are inversely related, and such two stocks can be constructed as a portfolio, so that your return is increasing but risk is reduced. How can you say that these two are negatively correlated? The correlation should be negative. If the correlation is equal to -1, then it is better to combine. If the correlation is +1, there is no any meaning at all by combining. Clear? Hope now you will be able to understand. See, in question number 1, the correlation is closer to -1. Because of that reason only, we are able to reduce the correlation by combining these two. Okay. If it is positive, we cannot reduce. And third question is combination of 3 shares in your portfolio. 3 shares, then weight of 1 and weight of 2. That's how you can calculate. But in case of a correlation of portfolio or standard deviation of portfolio, the formula is this much. Pretty massive. I request you not to refer this for your exam purpose also. You don't need to worry about this. 3 is not required. But of course, the video is available. If you want to have for additional learning, you can go for learning this, but it is applicable for the final level. For final level. Clear? See, this is one of the interesting illustrations for additional learning. Portfolio consisted of two securities, A and B. Expected return of A and B and standard deviations are also given. Find out the risk and return on the two stocks. If the correlation being either 1 or -1 or minus 0.5. These are the three scenarios. Now, you know that the calculation of formula is pretty massive. In case of return of the portfolio, it's pretty simple. Weight of A and return of A plus weight of B and return of B. We assume the investment made at the rate of 50-50. 0.5 and 0.5 you can calculate. Okay, what about the portfolio of A, sir? Standard deviation of portfolio. Weight of A, standard deviation of A, and plus weight of B and standard deviation of B. Actually, I told you this will not be true. But if the correlation between these two is equal to 1, then this one is true. Then this one is true. Is that okay? If I ask you to calculate, if I invest 10% in A and 90% in B, 20% in A and 80% in B, 30% in A and 70% in B, such a way you can calculate. Find out the best combination of your portfolio. Then actually it is not possible to calculate manually, but you can use the Excel sheets or latest apps. Here I already constructed an item here. See here. See here. And A's return being 10%, B's return being 25%, sorry, 10%, 20%, and this one being risk. This one being risk. Return and risk. Return and risk. Clear? This will be your return and risk for A and B. As already told you, 10% and 20% being the return, 25 and 50 being the risk. Okay. And if your correlation being, if the correlation being 1, the answer could be this way. Correlation or standard deviation of portfolio is equal to weight of A and standard deviation of A, weight of B, standard deviation of B. This will be true once the correlation is equal to +1. Okay. If I add 50-50, 0.5 A and standard deviation being 0.25, 0.5 of B into standard deviation of B being 0.5, what is the final value? 37.5%. Am I right? 37.5%. What about the return of portfolio if the combination being 50-50? Weight of A, return of A plus weight of B and return of B. Return of B. Weight of A being 0.5 into return of A being 10%. Weight of B being 0.5 into return of B being 20%. The final answer being 50-50, 15%. Is that okay? 15%. In case, if you plot that in the graph, I'm going to plot the same. in the graph. Okay. In case of portfolio, 15% and 37.5% portfolio. If I plot in the graph where correlation is equal to +1, this will be return, this will be risk. Return is anywhere between 10 to 20. So 10, 20. Risk being 25, 50 and so on. I plot this for A. For A, this will be 10 and 25. Return is 10 and risk is 25. This is A. In case of B, return is 20 and risk is also be increasing. Then this one is B. This is A and this is B. But if I combine the portfolio being exactly in the midpoint, 15 and this is 37.5%. If you connect these dots, this seems to be a straight line. As you are increasing the composition of B, you will be moving here. If you are decreasing the composition of B, you will be moving here. The moment higher the investment in B, it will be closer to the returns and risk of B. If you are investing higher in A, the risk and return is closer to A. If it is exactly 50%, then it's exactly midpoint. If the correlation being 1. Rather than calculating for the various combinations, I may use this Excel sheet. Here, A's return being, A's proportion of investment being 100%, B being 0%. Completely you are investing. And you are investing 90%, 10%, 80%, 20%, 70%, 30%. In this combination, I am investing. If I invest this, your risk is, see these two columns. These two columns. Okay. If you are purely investing in A and purely investing in B, purely investing in A as well as purely investing in B. If you are purely investing in A, your portfolio return also be similar to what? A's return and risk is also A's risk. If you are purely investing in B, then your portfolio return is also equivalent to return of the B and risk is also similar to that. But if the correlation being 1, how it should be? It's a straight line. Hope now you'll be able to understand the straight line here. This is A, this is B. And if it is 50-50, then you will get this value here. If the proportion is more of B, then it will go here. If the proportion is more of A, this will go here. See the answers. See the answers. If you are investing predominantly A, your return is closer to A and risk is also closer to A. If you are investing predominantly for B, then your risk is also closer to B and return is also closer to. As you move anywhere between these two, it will be proportionately changing. In this scenario, what you can do? You can use this formula for calculation of risk. This formula will work. This formula will work only when correlation is equal to 1. Then if I add up what? Correlation being -1. If the correlation being -1, what does it mean? Perfectly negative correlated. This is perfectly positively correlated. In case of perfectly positively correlated, we have no advantage of constructing the portfolio. Perfectly negative correlations, then you can construct these two and you can make your risk being 0. Return is also increasing, risk is also being 0 at certain point in time. Now it's your duty to find out what's that exact proportion so that your risk will be 0 and return will be higher. Okay. Now I'm going to introduce what? Rather than risk being 1 here, I make it -1. Automatically what happens? If it is purely investing in A, you will get this much. You'll get this much. If you're purely investing, this is the return, okay? Isn't it? 20% return and 50% risk, okay, for B. If you're purely investing in A, It is anywhere between 20 and 30, and this is 10. 10 percentage return and 25% risk. But exactly at what point in time? Two-third A and one-third B, your risk is 0, your return is 0.33 or 0.133. So your return is the maximum with neutralized risk. So as you are being the portfolio constructor, you need to choose the shares having perfectly correlated, which is not practically possible, at least closer to the perfectly correlated, 0.9, 0.7, 0.6 negative. If it is being the positive, no advantage at all. If you are considering two shares to be clubbed, these two shares are negative. It's not tea and coffee. Is that okay? That's the logic here. Now, in this case, you can absolutely minimize your return to 0, risk it to 0, and increase the return. C, A, B. Due to the portfolio, your return is almost 13.33%, and your risk is 0. Will you be happy or not? If you are investing only in A, your return is only 10%. If we ask you, is there any risk? Yes, sir, there is a risk. If I suggest you without risk, would you like to take at least 13.33%? Naturally, my return is increasing from 10 to 13%. I'm pretty happy, and risk is also reduced from 25 to this one. I'm pretty happy for that. So this is the diagram you have to understand, and this is also about Markowitz models. Let's see here all this thing. In case of correlation being 1, this is two shares. On mixing the portfolios, you will get the straight lines here. It means the risk and return will be corresponding to the combinations of A and B only. In case correlation being -1, this is A, this is B. If you are able to find out the exact level, a combination, you can neutralize that risk, means risk being 0. If the risk being 0 means it should be in y-axis. And your return is gradually increasing as it move from right to left side. Thereafter, risk also increases, return also increases. If your customers are willing to minimize or reduce the risk and increase the profit, this is the most suitable choice. Thereafter, you can recommend the customers. If you want to get more, then of course there will be risk. You can suggest anywhere here. Okay, and this will be the most suitable choice for the risk averse investors. Sir, what happens, sir? I already told you, practically +1 and -1 not possible. If it is anywhere between these two, how this could be, sir? This is A, this is B. In case the correlation being -0.5, definitely backward and again comes back here. Okay, but it will not be equal to 0. Standard deviation of the portfolio cannot be, means risk cannot be 0, but you can minimize. As you are moving closer to y-axis, the risk is gradually decreases, and where the exact tangent point, your risk is the maximum possible minimum, and your return is also higher. This seems to be this diagram. Actually, Markowitz suggested we have n number of shares. It's not 2 shares. I have 4 shares in my combinations. I have 10 shares. What happens? Actually, you can construct the correlation, means portfolio using the shares having the correlation anywhere between -6 to -4, like. Okay, perfect, not possible, but anywhere between minus. Plus is not useful. If you choose 2 shares having -0.5, then this diagram will look this way. This is between A and B. What happens for C, sir? Between B and C, this will look this way. Between C and D, okay, if you connect all these things, this seems to be broken egg format, and overall value will be this way. It's a broken egg model for the Markowitz portfolio constructions model. So I am confined with only 2 aspects. If you have the multiple one, then You connect this way to get the diagrams here. It seems to be broken egg model like, okay. Now I'm going to introduce what? Minus 0.05. This value seems to be this way. Is that clear? Instead of minus 0.05, if I make it 0.5 positive, it will not move to the y-axis again. It will not go to the y-axis. When you are getting the advantage, only when the curve goes closer to the y-axis, means you are reducing the risk. Otherwise, the logic is immaterial, not available. So that's the reason the correlation should be negative. If it is negative, definitely you will take some advantage. If it is perfectly correlated, means -1, you can take the most benefit out of that, means risk will be 0, which is not practically possible. Okay, which is not practically possible. So this is the diagram for the maximum possible one. So minus 0.1. Okay. 0.1 minus. Yeah. Oh, sorry, 1, -1. -1 will be the most suitable. If I ask you, how can we calculate that exact combination? Sir, you got me, you got this value being 66 and 33%. How do we get this, sir? It's very simple. You have been given a formula for this. You can apply this formula to get the direct answer. This is the answer. Optimum mix can be arrived using this formula. Weight of A is equal to standard deviation of B divided by standard deviation of A plus standard deviation of B. That's how you can find out the weight. Standard deviation of A in this case being, this is the formula I'm going to use. Okay. In this illustration, standard deviation of B being weight of A is equal to standard deviation of B being 50, standard deviation of A and B being 25 plus 50 is equal to 2/3. Weight of B is equal to 1 minus weight of A, or you can apply the same formula, standard deviation of A divided by weight of standard deviation of A plus standard deviation of B. That's how we can get this answer. So final answer being 1/3. 2:3, 2:1 is the perfect ratio where you are able to get the maximum benefit out of the portfolio. Is that okay? That's how we got the answer, and I calculated this value here. Because of that reason only we touch this point. Else we cannot touch. Else we cannot touch. If I make it 0.5, what happens? .5. Then it will not touch because it's not perfect combinations. Perfect combinations. Okay. What is a perfect then? 2:1. 2 shares should be A and 1 share should be B, so that you can minimize the risk or even make it 0. Hope now you'll be able to understand the Markowitz model and all. Of course, this one is for your understanding, and I have given the picture also here for your better understanding. Manually calculating all these things and posting here is pretty tough, but I explained all these things. But if you are supposed to draw the graph in your examination, in these cases, you can guess the graph easily. This is correlation -1. This is correlation +1. This is correlation minus 0.5. That's all. With that, Markowitz model is over. Clear? Now let me move on to the next one. Certainty equivalent approach in case of capital budgeting, and then I directly move on to the William F. Short model. William F. Short model also very rare for your examination purpose. Actually, CMA Inter, they have just explained about the relationship between risk and return. Every financial manager is planning to reduce the risk and increase the return. That's what about the intention. Because of that reason, they have incorporated this as an example. It is not practical problem. It's an example it's given. So I have explained all these things in detail. Okay. Hope now you'll be able to understand. Let's try to solve the certainty equivalent approach based illustration. Again, you will be studying all these things at your final level only. Here, in case of risk, how can you behave for capital budgeting decision is explained with an illustration. That's all. Now, see, the Globe Manufacturing Company Limited is considering an investment in one of the two mutually exclusive proposal projects X and Y. You have to study this only after the capital budgeting chapters, not now. Okay. As you already completed capital budgeting, it's okay. You are going to calculate the cash inflow, means the NPV only here, which requires cash outlay of rupees 3 lakhs 40 and 3 lakhs 30 respectively. So for project X, cash inflow is given and outflow is also given, and cost of capital being 8%. Cost of capital being 8%. What do you do usually? Cash inflow of the project. You have to find out the PV factor for 8%. 8% PV factor being 0.926, 0.857, 0.794. Now you have to find out the discounted cash inflow. How do you get the discounted cash inflow? Cash inflow is multiplied with the PV factor. If you sum this is called summation of discounted cash inflow. From there, cash outflow is subtracted to get the NPV. In this case, cash outflow being 3 lakhs 40, then you will get the NPV for project A, project X. And in case of project Y, you have to again calculate the discounted cash inflow by multiplying the cash inflow with the PE factor and take the summation of that. For that, you have invested 3,30,000 rupees. If you subtract, then you will get the NPV. But what is certainty equivalent approach? You are aware about that investment today. You could have inquired about the investment required for starting this particular project, but the return from this is only prediction. It's not guarantee. Is that okay? So the prediction given in this case being 1,80,000 is the cash inflow in the very first year. If I ask you, means the valuer may give you 1,80,000 being the cash inflow. If he tells you 1,80,000 being the cash inflow, immediately I'll ask you, is it guaranteed? Sir, no, sir. In the worst scenario, at least you'll get 80%. That is what about certainty equivalent. What happens in your examination after completing the exam, writing the exam? You value yourself. You'll get around 70 marks or 75 marks as per your liberal valuation. Then you'll go for the strict valuation, reducing some mark. Anyhow, at worst scenario, you'll get 50, very comfortable. Worst scenario, you'll get 60, very happy. That's how you'll do, no? You estimated a number. If I ask you, is it guaranteed? No, sir, at least 80% may come. Based on the certain based cash inflow, I will calculate the NPV. This is called certainty equivalent approach. In this case, you have to multiply what? Cash inflow multiplied with the certainty equivalent and then present value factor. So cash inflow, applicable certainty equivalent, and then PV factor. If you multiply, then what's the value you are getting? 1,33,344. It is not 180 into 0.926. One extra work is done here, which is nothing but multiplying the cash inflow with the certainty equivalent. Okay. Similarly, for the year 2 and year 3, 1,19,980. The next year, 79,400. Overall value being 3,32,724. Your NPV in this case being negative 7,276. So it should be rejected. In case of project Y, 1,80,000 into 0.9 into PE factor. The value being 1,50,000. 12, and next one being 1,23,408, then 1,11,160. The overall value being 3,84,580. Yeah, of course, you have the positive value 54,580. In this case, this project can be accepted, this project is rejected. That's all about certainty equivalent approach. This illustration also for understanding purpose only. For your examination, it's only understanding. How can you behave in case of your investment seems to be riskier? You can use the either certainty equivalent approach, or you can take the mean average of the 4 or 5 values we have calculated. And how can you escape constructing a portfolio? These are the ideas given for escaping from the risk. Exact these questions may not be asked in your examination. It's only theory topic like in your examination, right? Now, now, in case of Markowitz model, no. If we have 4 or 5 items or investments for our portfolio, you need to have n number of correlations. If we have only 2, A and B, I need to have the correlation between A and B. If you have 3, I need to have the correlation between A and B, B and C, and A and C. If you have 4, the number of correlation requirement may be higher than the calculation is pretty massive. Is that okay? So for the 3, the formula is given here for your understanding, isn't it? I will explain you to how to memorize that formula in case we have 3. Okay. Here this formula. How do you calculate? In case if we have 3, understand that A, B, C like. For understanding the formula, here is a beautiful format given for understanding the formula here. It's not a formula, it's for understanding the or remembering the formula. Okay. Security 1, security 2, security 3, and security n. Okay. If you have 2 by 2 securities, your correlation formula will be this much. Okay. 1 means W1 standard deviation 1. 2 means W2 and standard deviation 2. That's how you can remember. If we have 2 by 2 matrix, 2 by 2 matrix, 1, 1, 1, 2, 2, 1, 2, 2. Is that okay? 1, 1, 2, 1, 2, 1, 2, 2. 1 means this one. So, W1 square, standard deviation 1 square, W2 square, standard deviation 2 square, plus 2 into W1 standard deviation 1, W2 standard deviation 2, and don't forget to multiply the standard deviation correlation between 1 and 2. That's how the formula is derived for easy remembrance. Okay. So, one, 2, 3, so on up to n. 1, 2, 3, so on up to n. Here what happens? W1 standard deviation 1, W1 standard deviation 2, sorry, standard W2 standard deviation W1 standard deviation 1. Here W1 standard deviation 1, W2 standard deviation 2. Is that okay? Here 1, there 1. Clear? In this case, W1 standard deviation 1 square. Here W1 standard deviation 1, W2 standard deviation 2. In this case, 2 and 2, W1, W2 square, standard deviation 2 square. Is that okay? Are you able to understand the way of writing? Again I will write it. 1 is equal to W1 standard deviation 1. 2 is equal to W2 standard deviation 2. Is that clear? Here 1 and 1. Here 1 and 2. Here 2 and 1. Here 2 and 2. Am I right? It's a cross multiplication. 1 and 1 this one. 1 and 2 here. 2 and 1 here. 2 and 2 here. Is that okay? You can understand the logic. With this small logic, 1 and 1 means 1 is W1 standard deviation 1, but 2 times no square. Here W1 standard deviation 1 and 2 W2 standard deviation 2. And here W2 standard deviation 2, and for 1 W1 standard deviation 1. And here W2 square standard deviation 2 square. When we have W1 and W2, better include correlation between 1 and 2. Correlation between 1 and 2. For 2 matrix, you take up these values and write. Okay, W1 square standard deviation 1 square, W2 square standard deviation 2 square, W1 standard deviation 1, W2 standard deviation 2, correlation 1 and 2 twice. That's why we use simply 2 here. Simply 2 here. This is how the diagram is. It means formula is derived for understanding. In case of 3, what happens? In case of 3, here W1 standard deviation 1, W3 standard deviation 3, correlation 1 and 3. Here W2 standard deviation 2, W3 standard deviation 3, correlation 2, 3. Here W1 standard deviation 1 and W3 standard deviation 3, correlation 1 and 3. Here W2 standard deviation 2, W3 standard deviation 3, correlation 2 and 3. Here 3 in 3, right? So W3 standard deviation 3. But 2 times no, you just use the square. Now for 3 by 3, you have to take all these values. All these values. First, I'll write these values. W1 square, standard deviation 1 square. W2 square, standard deviation 2 square. W2 3 square, standard deviation 3 square, plus. Now these two resembles like same, 2 times of that. 2 times of W1 standard deviation 1, W2 standard deviation 2, correlation 1 and 2, plus I'll take these two. Okay. These two. Here 2 times of W1 standard deviation 1, W3 standard deviation 3, standard deviation 3, okay, into correlation 1 and 3. And finally these two. 2 times of W2 standard deviation 2, W3 standard deviation 3, and correlation 2 and 3. Take the root of this. Take the root of this. This is what about standard deviation of portfolio, where we have 3 shades in our portfolio. 4 means what happens? W1 and standard deviation 1, W4 standard deviation 4, and correlation 1 and 4. That's how you can expand 4 or 5. Seems to be pretty massive, not required for your examination. Anyhow, at least if you get 3, you should be careful. 1 square, 2 square, 3 square, 1 and 2, 1 and 3, 2 and 3. This is nothing but A plus B plus C whole square. A square plus B square plus C square plus 2AB plus 2AC plus 2BC. That's a formula like you can remember in case of 3. In case of 4, A plus B plus C plus D whole square formula. So that's how you can expand. Of course, you have the idea, more, not more than that. It's not required for your inter level. Clear? Now, now let's move on to the William F. Sharp model. William F. Sharp model. This model you might have already studied. William F. Sharp model. How do you calculate the cost of equity? Come on, tell me. Cost of overall capital can be calculated or equity can be calculated. How? Risk-free return plus beta into market risk return minus RF. This is the formula you might have studied in KO calculations. This KO calculation is usually propounded by William Sharp. This is called capital assets pricing model. See, the main drawback of Markowitz model is we need to have the correlations, n number of correlations. If we have 3 items, you need to have n number of correlations between 1 and 2, 2 and 3, and 1 and 3. If we have 4, 1 and 2, 2 and 3, 3 and 4, and 1 and 3, and then 1 and 3, and 1 and 4, and 2 and 4, like. So, really time consuming. But William F. Sharp made it simple by introducing this formula. Now, here, the risk can be of two types. One is systematic risk, another one is unsystematic risk. Systematic risk due to macroeconomic and market risk, non-diversifiable. You have to face the risk. During the COVID, all face a toughness. That is called systematic risk. Unsystematic risk is related to specific to company. If the risk is related to company A type, start investing in B type to be safer. So you can simply diversify from one company to the other company to reduce your risk. Is called unsystematic risk. And for the unsystematic risk, you can use this formula directly. Okay, if you are investing in the stock market, this is called market risk premium, RM minus RF. If you are investing in the bank, you will be getting a decent return, which is called RF. But if you want to invest in the market, it's riskier, so you depend on higher return. Only then you will be motivated there. So this is what about RM minus RF. If you invest in the bank, you will get this one. If you want to invest in the stock market, the extra return you expect from the stock market is RM minus RF. But you are not investing in all the shares. You may be investing in only one share, you know. Now you have to find out what is the risk of that particular one share with respect to the market is represented as beta. Right. In this particular class, we are going to guide you how to calculate the beta also. The calculation of beta, I am going to guide you. That's all. Of course, not required for your examination. I just guide you. But this question, of course, you might have studied along with your what? Earlier study. KO calculations. Calculate the cost of equity capital of SSA Limited, whose risk-free rate of return being 10%, the firm's beta is equal to 1.25 and market portfolio being 16%. Firm's beta, otherwise beta. So the formula being RA, return of A is equal to risk-free return plus beta into RM minus RF. Risk-free return in this case being 10% and plus beta being 1.25%, 1.25 times, RM being 0.16, RF being 0.1. If you calculate the final answer being 0.175 or 17.5%. Is that okay? This you might have studied along with the KE calculations under cost of capital chapter. This is nothing but CAPM approach. There I stated this as being the CAPM approach. That CAPM approach is propounded by William Sharp here. William Sharp actually simply introduced this beta calculation instead of correlation calculation used for Markowitz model. There we need n number of correlation. Here only the B. Whatever the share you supposed to choose, you need to have the beta of that particular share. That's all. Duty is over. Clear? How to calculate the beta, sir? How to calculate the beta? The calculation of beta is very simple. Here is beta is equal to covariance. Already told you what is called covariance. Covariance is nothing but variance of A and variance of B. If you are multiplying these two, then it's called covariance. Covariance between particular share with respect to the market. Market means probably Sensex or Nifty. The Nifty's movement is M, and if you want to study about the probably a particular share, Tata Steel, how far the Tata Steel's share is reflected or changing with respect to the change happens in the market. The market change is M. The Tata Steel Company share is named as A. If you are taking these two variances and multiply, that's called covariance. And usually, in case of correlation, what do you do? Covariance between A and B divided by standard deviation of A and standard deviation of B will be taken. But in case of beta, not with respect to A and B, it's with respect to the market only, so you have to take the standard deviation of market square. You are multiplying these two. The same correlation formula is used here as a beta, but here the covariance between the particular share in which share you want to invest is compared with the market's variance divided by market variance is the new denominator value. Now, how do you calculate the variance here? Variance is very simple. Covariance between A and M is equal to return of A minus return of A bar and means x minus x bar for A as well as x minus x bar for M. Similarly, return of M minus return of M bar, multiply these two and take the summation of this, and divide this by n or n minus 1. Or simply you can skip this n minus 1 also because it has no meaning. Okay. Okay. In case of standard deviation or variance of market, how do you calculate? Rm minus Rm bar to the power 2 is the variance and take the summation divided by n minus 1. As here also you have the n minus 1, here also n minus 1, you can simply remove that n minus 1 also. If you have the n, no problem. If you don't have the n minus 1 also, you get the same answer. Right. Finally, to find out the beta, you can use these two formula to arrive the beta here. Is that okay? And one more formula. So you have to understand. I hope you will be now able to understand this formula. And you learned the calculation of variance of the market also. And you learned the covariance of the market and particular securities also. You have learned all these things. Now, this can be rewritten this way. How? Covariance of A with respect to market is equal to standard deviation of A and standard deviation of market multiplied with what? Correlation. The other way of stating the covariance is this way. Okay. This covariance formula can be found out this way also. We have the two formulae here. Okay. Covariance of A and M is equal to correlation between A and M into standard deviation of A into standard deviation of M. So, question number 2, I have given return of A as well as return of market for 10 periods. You have to find out all the calculations required for this and try to find out the beta and try to apply this for your study. Okay. Of course, not required, but only for learning purpose, I have given this one. Learning purpose, I have given. You understand this formula? Okay. That's all, not more than that. The question number 2 and 3 is for understanding purpose. I will explain the formula here in detail. Okay. So, what are the formula I taught you? Beta formula is equal to covariance between particular security with respect to the market divided by variance of market. The covariance can be calculated this way. Covariance between A and M is equal to standard deviation for means variance of A and variance of market divided by n minus 1. Variance of market is calculated this way. Okay. X minus x bar for the market to the power 2 divided by n and take the summation. Here also summation symbol should be there. The covariance otherwise can be calculated this way also, which is nothing but the other way of this correlation formula. Okay. Covariance between A and B is equal to correlation between A and B into standard deviation of A and standard deviation of B. So you better understand these four formula and try to solve the question number 2 and 3 yourself, not more than that. Okay. Hope now you'll be able to understand all these concepts here. Now, I'll show from your insert material. Already I solved all the questions from your insert material also. You can go and see. To make you understand how far it is given in your text, I am showing this from your text. So this is all about the chapter related to risk and return. Risk and return. Okay. Time value of money we already completed. Risk and return. In this chapter, they have guided you to understand the risk and return and how to behave for that. Okay. So all the returns risk is given here. Total return and all these things are given. Average annual return, expected return of the portfolio, and this formula. If you study, definitely you will not be able to understand this. The expected return, variance, and standard deviation if the probability is given. Okay. And beta also given. So beta is calculated for this. Capital assets pricing model. These formula also I explained in detail. Okay, return of equity is equal to risk-free return, beta into RM minus RF. Okay, and certainty equivalent approach, solved cases. There is no coherency of this topic. Here are there, jumped, here are there, that's all. But anyhow, I given a coherency even a step ahead of this one. So after this, if you go and see your institute material, it's pretty simple. Okay. So with that, this chapter is over. Probably in the next class, I'll start with fund flow statement Thursday. Thursday, I'll finish up fund flow statement. And Friday, we'll start with the costing paper parallelly. Cash flow statement will be arranged a day, so that it's a common chapter. We'll finish up cash flow statement. With that, FM will be completely over. Okay. See you in the next class then.